extension is your friend. Extensions are wonderful and you should not be scared of them. So many people are like, oh, it increases my audit risk. It does not. It can actually decrease the audit risk because the return is done correctly, right? There's no time, there's more time spent on it, less time, less chance of error. So extensions are good.
Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment, the podcast. My name is Jeb Graham, here with Eric Wymore and Ethan Hutchison, and we have a special guest today, Christine Nosbush. How are you guys doing?
We're well.
Awesome. Yeah. So Christine is an enrolled agent, and she owns Nosbush Tax and Accounting Services. And, this is coming out mid-January. We figure this is the time people are going to start having 1099s roll in. They're going to get some 1099Rs, starting to think about taxes. And we thought this would be a great time to, number one, talk about wrapping up your 2025 taxes. If there's anything we can do between now and tax time to hopefully mitigate that tax liability or just get you more organized. And then as well, maybe planning this year for your 2026 taxes. So, but I think the big question folks might have, Christine, is, and I tell you what, until about a year ago, I had this question too, is what is the difference? You got, everyone hears about CPAs and then there's enrolled agents. So maybe we can talk a little bit about the difference of what is a CPA versus an enrolled agent when it comes to tax planning.
Sure. That's a great question. So an EA, it has a federal license. I'm licensed by Treasury. I am an EA, so I'm licensed by the Treasury and my license is federal, which means I can work in all states. My focus and EA's training's focus is on the tax law and on tax code. Whereas now a lot of us do have a background in accounting, but CPAs, their focus is accounting and attestation. And so that's not to say that they can't do taxes. Some of them train extra and learn extra to learn about taxes. But that's basically the difference. And a CPA has a state license. One thing about EAs, we are trained in representation, so we can represent it.
So as far as the training though, it's probably on both sides, it's a pretty rigorous program to get from one side to the other.
Absolutely. Yeah. Absolutely. Yeah. Absolutely. CPAs have very rigorous training, as do EAs.
Nice.
And with that being said, an EA obviously spends a lot of their time on tax preparations and understanding the tax code. There's been a lot of changes that have gone on in the tax code recently in the last, call it 5, 6, 7 years or so. What are some of those tax laws that have changed, or the tax codes that have changed that might be a little bit more, might be a little bit more where the affluent family should be considering?
Well, I think for sure, just this year with OB3, the One Big Beautiful Bill Act, or whatever we're calling it at this time, lots of changes for the more affluent family. Looking at the increased SALT deduction, but then also making sure, working with your financial advisor and tax preparer to make sure that you're staying in the limit under $500,000, changing the deductions and how those are taken. There's a lot of things with that some good planning can be done to help that affluent family right now.
Given all the changes that have occurred, what do you think is, from your point of view and perspective, what's the biggest mistake or things that you catch often that aren't taken advantage of by some high income earners and things of that nature?
So really it depends on the point of their life. But if we're talking the high income earner and say, a lot of times their 50s and 60s, right? Watching what they're spending, controlling what they're spending, because in retirement, maybe that level of income won't be there, or they're going to have to learn to live on less. So that's number one. Fully funding the HSA. Everybody knows about the Roth and the traditional IRA and those sorts of things, but the HSA can be a great, great planning tool for people. maybe looking at 529 plans, where those can roll to Roth if they're not used, for education purposes. Um, there's a lot of things that can be done for that high income earner, but they need to know and need to be able to take advantage of those situations while they're earning that high income.
Well, I'll tell you real quick is that HSA, because you hit on this, and I totally agree there, is that, everyone always talks about their IRAs, Roth IRAs, so on and so forth. Actually, the best tax break between all those is the HSA, which a lot of people don't realize is that it has that triple tax exemption. Can you talk a little bit about that?
So the HSA, this is pre-tax money that's going in, and it can be used tax-free for any medical expenses. So, for instance, a client called me. He thinks he's going to be laid off. He's got a lot of money sitting in his HSA. I said, you can use that tax-free to be paying for medical expenses. If you cannot use your HSA and pay for your medical expenses outside, you can reimburse yourself for those expenses in later years, and it can be a source of tax-free income to you, um, to help with planning to keep you under certain levels.
So, Christine, what are some of those limits on the HSA that you can contribute each year?
So for a family, you can contribute $8,750, and then there's $1,000 catch up per person if they're over age 55. If you're single, it's 4,400, and then again, $1,000 per person catch up if you're over age 55.
And so that's definitely something that could really start to build up over time if you're able to max that out or get close to maxing that out on an annual basis.
Mhm.
And so, like from our client's perspective, they get the benefits of a traditional IRA, right? Where you get the tax deduction for putting it in, and then basically you get the benefits of the Roth IRA kind of, or 529, as long as that's used for medical expenses, right? So it's the only thing you have that gives you the deduction as well as that tax-free growth, that we've kind of come across. Back real quick. So I know you talked a little bit about IRMAA a minute ago, or at least I think you talked a little bit about IRMAA. And I do think that's something that we run into all the time. Well, a couple of things that we run into. We run into people trying to control their income between, call it age 62 when they retire and age 65 to keep their health insurance premiums at a lower level, as well as trying to keep it once they get onto Medicare, trying to keep it lower so that they don't have to pay out of the wazoo for their Medicare supplements and things like that. So, can you talk a little bit about strategies that maybe come into play now that people could try to hopefully keep their income below those thresholds?
So yes. So IRMAA's a Medicare surcharge that hits people when they reach certain income limits at retirement. And it's, for instance, for 2026, so we'll be using the 2024 numbers, right? Now there are waivers in certain situations there too. However, not to sound like a broken record and make this the HSA conversation, but what a beautiful way to bring income into your household that's tax free, that's not going to raise those IRMAA limits, right? Um, the Roth, again, an excellent way, right? Because that's tax free money when it's distributed. Um, trying to work with your financial advisor to make sure that you're limiting your cap gains. Because again, that's all going to make a difference. So there's various strategies for various people depending on where they are um, in their planning and what they can do and what they're willing to do.
Yep. And that's another thing that we've done with a lot of clients is trying to help them in their younger years before retirement. Is you've got your Roth IRA comes out tax free, HSA comes out tax free, um, but then a lot of people, their other asset would be their traditional IRA, right? Which they take that out. That's going to layer additional income on top of whatever they're making from Social Security or whatever they're taking. The other thing we talk about is just setting up either a trust or a non-retirement account as well. So even though it's not the most fun thing to save in when you're younger, because you don't really get huge tax benefits from it, it can be really, really handy in those years when you're either trying to do Roth conversions or you're trying to stay under those IRMAA limitations as well. So I think that's another thing that we've talked to clients about, and I would assume you probably would agree that the more money that you can get at without generating taxes in retirement is going to help you a lot.
Absolutely.
And real quick, Christine, it's a look back provision, right? So if you're filing for Medicare at 65, they're looking at your income at age 63, and then that's kind of a moving target in lockstep. So if you do a big Roth conversion when you're 67, that hit your IRMAA adjustment at age 68, or will it happen at age 69?
At age 69.
Gotcha. Okay. Cool.
Well, based on the calendar year, yeah.
Yes, right. Understood. Yeah, that's something that we've watched. We were doing conversions for a client a couple weeks ago, and he wanted to go big, and we told him, well, you be careful because there's consequences to doing that. So we kind of controlled that conversion under the IRMAA limits. So
Yes.
kind of some planning along those lines. Awesome. What do you think right now, given it's, we're recording this mid-December, this comes out mid-January. I guess that time frame, what could people be doing to prepare for filing taxes?
So in December, they can be talking with their financial advisor. They can be talking with their tax professional to see if there's anything they can do at the end of the year. In January, we can look at, can you put money in a traditional IRA? Can you put money in a Roth IRA? Can you fund it more into your HSA? Well, did you hit the limits in the prior calendar year? Because those things can be done before the tax return files. As far as just the nuts and bolts, it's just knowing what you had in the prior year and making sure you're collecting those documents so there's nothing that's going missing at tax time, to get ready for the preparation itself.
I'll tell you another thing. This was actually last month's podcast, and maybe you can talk about this from a tax preparer's standpoint a little bit. But we actually did a podcast about general consolidation of accounts, right? Because we have clients, and I'm sure you have customers, right? And clients that basically have accounts everywhere. So they might have one at XYZ brokerage, the other one at ABC brokerage. They've got 4 different banks. They've got all this stuff. And then come tax time, they're basically waiting on a lot of different tax documents to come in. And, a big thing that we try to push with our clients is consolidation, and how much not only does it make the tax time easier as far as collecting documents and all that, but it helps them probably avoid forgetting about certain accounts or forgetting to file or missing certain things that could make them have to refile taxes or even pay penalties down the road. So.
Absolutely. But I think even the most important thing is when you have money in all different places, it's really hard to plan. And so if you want to plan, especially with financial advisors, you should have a financial advisor that knows all your things, right? And if everything is in house in one spot, it makes it much easier to do that.
Certainly.
We agree with that. So.
Yeah.
Absolutely. Early on, you mentioned that you represent people, and so oftentimes, I'm sure that happens every once in a while. Could you elaborate a little bit on what that means? I mean, are you getting into if there's an audit situation, or if it's having to represent them in some kind of a case? Can you share a little bit of that?
Sure. So representation covers a couple of things. For instance, if you are audited by the IRS, and there's various levels of audit that the IRS will do, I will represent clients in those audits whether it's correspondence or it's in office, or you actually have an auditor that comes to your place of business, right, and looks through your records. So I can represent clients in that. And then the other one is maybe people that have gotten in trouble, have gotten behind on their taxes or things like that, helping them put together some sort of plan. Of course, the Holy Grail is always the offer and compromise, the pennies on the dollar thing, which is rare, very rare that works. But there are other things we can do, some penalty removal, things like that, and different structured payment plans that can bring that client back into compliance.
So can you explain that, because you always hear about like a tax attorney jumping in certain circumstances like that. So when would one of our clients need to use an enrolled agent? And then when do you have to step over the line and kind of start going into the legal area of using a tax attorney?
So in the IRS, there's a certain division called Criminal Investigations, or CI, and they carry guns. And if they show up, call a tax attorney. For everything else, an enrolled agent or a CPA that does do representation can help you.
Okay.
Duly noted.
Yeah. So the attorney's the last resort there, right? That's when you need somebody with a gun. That's when you get into that sort of thing. That's fine.
Correct. Because then we're in criminal territory.
Okay. All right. Well, hopefully none of our clients are going to run into that, but you never know, I guess.
Yeah.
Right.
So what are the red flags to avoid the IRS agent that comes with a firearm?
Well, that's usually fraud, and that's kind of a high bar, right? That's a criminal issue. So I have not run into that with any of my clients, fortunately, nor myself, just for the record. Um, but to maybe just to avoid the audit, first of all, you should take all the deductions that you're allowed to take. There's no problem with that, right? As long as you have proof of them. But where people get into trouble is maybe cash intensive businesses, right? Those are going to trigger an audit more than anything else. The complexity of a return, because there's just so much to get correct, that's going to trigger an audit, or could. I'm not going to say that's going to trigger an audit. That's incorrect. I would say that you have maybe a higher probability of being audited if there's a lot of complexity in your return. Large fluctuations in income, $1 million one year, 400 the next. What's going on with that, right? And it just could be that that's the way it is. We obviously don't make up income so it matches the prior year or something like that. Large deductions that are non-cash, if they're not handled properly on the return with the proper appraisals and documentation that's needed for those things, those will trigger audits.
So when you speak about complex tax returns, you're not talking about the standard two W-2 employees with a side business. You might be talking about, a business owner that has multiple businesses, a couple rental properties in different states, a large trust. So you really start, getting real complex. But your average, engineering firm employees that own a rental, they're not going to really be subject to most of that.
No, not generally, unless again there's some sort of flag on the return where it just doesn't make sense, right? That you would look at the tax professional, if I were looking at that return, would say, wow, this is really unusual expense here. What was this? And it may be legit. And if so, okay, but it's going to be a
So this is kind of and I don't know if you can answer this or not, but like when we have a client that has a relatively simple return, so it's a W-2 employee that puts money in their 401k, maybe has some children, those deductions, stuff like that. What should they expend? And the reason I ask this is we had a couple of CPAs and enrolled agents that we were using a few years back and we still do use them because they're phenomenal. But we noticed a very big price hike across the industry. And I don't know if this was an industry type thing or if this is just simply inflation, but it seems like a lot of clients used to be able to go get a $250 return or a $200 return. And now all of a sudden they're going with no more complexity than what they had then. And now they're paying, 400, 450. It was almost like a double. Can you speak a little bit about that? Was that like an industry wide?
There are fewer and fewer qualified tax professionals. Um, and I mean, when I say qualified, I mean qualified. Um, and there are fewer and fewer. There's not a lot of people that want to come into the business because, you've heard the horror stories of all the hours that we spend between January and April, and so there's a big change in the industry to not do that, and to spread that work out, and b there's just fewer and fewer of us that really know what we're doing, right? So that drives it, but also the due diligence that's put upon the preparer. So you have a husband and wife, let's just say they have a W-2 each, and they have 2 kids. The due diligence that I have to do in that tax return to make sure that to cover myself if my office is audited by the IRS, for all those credits that are available. When you have children, if there's EIC on a return, any head of household, all those really education credits also really require a lot of due diligence and time from the tax professional to make sure that those are legitimate deductions.
Gotcha. Yeah, I figured it was because originally we thought it was just the people we were working with were like, man, they really raised their prices. And then we talked to other people and it seemed like it was all kind of around the same time and prices went up pretty significantly. And honestly, I think it's justified personally, because I do think $250 is very cheap to have a tax return done in general. But if you were to say, what is a reasonable amount that they should expect, that kind of W-2 married couple, kids, what is a reasonable amount they should expect to pay, like in 2026, to get their taxes done?
Well, the other thing that I didn't mention before is the complexity of the tax code and how things have changed. And there's rarely a simple return any longer. With what we've added now with tips and overtime and things like that, I would say 500 would be a very minimum price that people could expect to pay for a tax return.
And that would probably be in line with what they did if they went to one of the big like H&R Blocks and stuff like that as well, right? Because it wasn't just like the independent people; it was also like the bigs that there too, and that makes perfect sense. So awesome.
I guess my question would be, when seeing that there is a shortage, when should someone reach out to you or other tax professionals to schedule their their tax appointment?
Last month. No, so if you have a tax professional that you're working with and you've worked with them for years, reaching out early, getting on their schedule early, or making the plan to be on the schedule, let's say the beginning of March or something like that, right? Once you know you're going to have all your documents. But the earlier that you plan for that, again, once you know you're going to have all your documents, the easier it is for the tax professional plan and the more likely that you may get done before the April 15th deadline. I will say that the extension is your friend. Extensions are wonderful and you should not be scared of them. So many people are like, it increases my audit risk. It does not. It can actually decrease the audit risk because the return is done correctly, right? There's no time, there's more time spent on it, less time, less chance of error. So extensions are good.
Well, very good. So if one of our clients, obviously we've shared clients over the years, Christine, and I know you've taken super, super great care of our clients that we've sent over and vice versa, and we really appreciate that. But if one of our clients wants to get a hold of you, or anybody that's listening to this does want to get a hold of you to do their taxes this year, how can they get a hold of you?
So the best way would be to go to www.nosbushtax.com, and there'll be, if you go to schedule, there'll be a special link for Metcalf Partners clients.
Awesome. And what's the benefit that someone that goes through the Metcalf Partners link gets?
They do not have to pay an initial consultation fee. So they can talk to me for free to see if we're a good fit.
Well, we really appreciate you coming on Metcalf Money Moment, and it's been a good conversation, and hopefully you have a good holiday. And by the time this comes out in January, you aren't too busy and regretting that you did this because of all the additional phone calls that you're getting. But thanks again. And this is Metcalf Money Moment podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.